So let's start with IAS 21, which deals with foreign currency. When we talk about foreign currency, the standard puts a lot of emphasis on something called as a functional currency. Now, what is a functional currency? A functional currency is the currency which is the currency of the primary economic environment in which the entity operates. So, if the entity is operating, let us say in US, then dollar becomes the functional currency. If it is operating in India, if its operations are being impacted in India, then INR becomes the functional currency. Now, here the thing that we have to keep in mind is a country may be registered in India, a country may be registered or incorporated in India, but operations are in US or sales happen in dollar. In that case, if dollar is the dominating currency, then dollar becomes the functional currency, and because the company is incorporated in India, INR becomes something called as the reporting currency. INR becomes the reporting currency. So, based on the operations, the sales, the currency in which cost is incurred, all of this put together, you will see what is the functional currency and what is the reporting currency. Now, the rule of thumb is all the transactions must be recorded in functional currency only. So, whenever you record transactions, you have to record the transactions in functional currency. Now, the reporting currency may be different than the functional currency. Then in that case, when you have to report in another currency, you have to translate. You have to translate this to the reporting currency. Another important thing is any currency other than the functional currency is the foreign currency. Any other currency is called a foreign currency. Now, this standard largely deals with how to account for foreign currency transactions and how to translate foreign currency financial statements. Okay. Now, when it comes to foreign currency transaction, it is very simple and straightforward. For example, there is a country whose functional currency is INR. The functional currency is INR. US is a foreign currency. Okay, US dollar is a foreign currency. Now, if this entity sells, let us say $1,000 worth of goods, sold $1,000 worth of goods, then how should the transaction be recognized? That is what is the question. Now, when you have to recognize the transaction in INR, what you do is you take the exchange rate. Exchange rate on the date of transaction. Exchange rate on the date of transaction, you will take the exchange rate and using that rate you will record it in INR. For example, $1 is equal to INR 80. So, you will say account receivable debit 80,000, revenue credit 80,000. So, this is how you will account for the transaction on the date of transaction. Now, sometimes you can use an average rate. You may not use the date of transaction rate, you can use an average rate only. Okay. So, this part is logical, there is no problem. Now, what happens is, say this transaction we have entered into on 1st of December of a particular year. There is a 2-month credit period. The amount will be received after 2 months. So, December, January. So, let us say the amount will be received on 31st of January of year 2. Now, the question is, in the balance sheet we have account receivable 80,000. Now, what the standard says is, if this is a foreign currency denominated item, is it a foreign currency item? Yes, it is $1,000. If it is a foreign currency item and if it is monetary, monetary means something which is determined in terms of money, cash, bank, loan, liability, receivables, where you know exactly how much amount is to be received. In this case, I know I have to receive $1,000. So if it is a monetary asset or a monetary liability, what you have to do is you have to restate using closing rate. Sir, what if it is non-monetary? Then you don't remeasure. If it is non-monetary, you don't remeasure. If it is monetary item, then you will measure using the closing rate. So say closing rate is 82. So now account receivable would be 82 into 1000, which is 82,000. Now from 80,000 I have increased the value of an asset to 82,000. This 2,000 profit, or you can call it gain of 2,000, this is recognized in the P&L. So two principles you have to keep in mind. Monetary items are remeasured. The gain or loss on monetary items are recorded or recognized in the P&L. Any question in this?
Yes.
Clear, right? Very simple, right? So that is it. Translation part is not tested, so that we can ignore it for our revision.
In this chapter, like monetary items here to translate and non-monetary items here, on transaction date, whatever you recorded.
Correct. So just to elaborate on that, let us say you purchased PPE on 1st of December of particular year for, let us say, $10,000 at 80. Okay. So what you will say, PPE debit 80,1212, that is 8 lakhs. Liability credit, let us say payable 812,121. Okay. Now PPE is something which you will no longer transact in the currency. Currency is no longer relevant. You have received the PPE, it is with you. So this PPE you will not touch again. This is a non-monetary item. Whereas this liability you have to pay, it is a monetary item, and hence you have to change it. So whatever is the increase or decrease will get captured here, it will not be captured in PPE. And please remember, it is not like what you learn in the Indian GAAP. There is no question of capitalizing to fixed asset and all of that. Everything has to go to P&L only. Any gain or loss on foreign currency transactions, remeasurement will be taken to P&L, right?
Yes.
Okay. Now moving on to IAS 33.
Sir.
Yes.
Yes, sir. And also in that chapter, one thing like what we face is when see inventories. Like suddenly it is current asset, but it is not a monetary item.
Correct.
We felt like it is also monetary items. So that part, I think that.
Yeah, inventory, just make a note of it. Inventory is a non-monetary item, and hence you will not be restating.
Yes.
Coming to IAS 33, this deals with earnings per share, a very important component in presentation of financial statement. Very important thing to remember, you will present them as cents per share. So whatever you calculate, for example, if profit is 1000 and number of shares are 2000, okay, you will multiply this by 100 so that you get cents per share. Okay, so you will always present it as cents per share even though the numbers are given in dollars. So that is one thing you have to be careful here. Now when you come to EPS, you have basic EPS and diluted EPS. When you calculate basic EPS, you take profit available or attributable to ordinary shareholders divided by weighted average number of shares outstanding. Weighted average number of ordinary shares outstanding. Now to calculate weighted average number of shares, there are two methods which I have taught you in the class. You can take whichever method you are used to it. Just thing you have to keep in mind is, for example, there is a particular date, 1st January of year 1, 10,000 is the number of shares, and let us say this is outstanding for 12 months. So what you will do, 10,000 into 12 divided by 12. If you make an issue on, let us say, 30th of June of year 1, 5,000. This is outstanding for 6 months, 5,000 into 6 divided by 12. Like this you calculate the weighted average number of ordinary shares outstanding. Weighted average number of ordinary shares outstanding. Now, weighted average calculation is simple. Few things we have to keep in mind again here is, if it is a bonus issue, you will assume that bonus is outstanding since beginning of period. So, even if you make a bonus issue in mid-year, you will give entire 12 months of weight to the bonus issue. Okay. Then, if it is a normal issue, you will give it, calculate the weights from the date of issue. Then another important part is rights issue. Rights issue has a bonus element and a full price issue. So, whenever you see a rights issue, what we calculate is theoretical X rights price. Theoretical X rights price. Now, when theoretical X rights price is calculated, you have to see what is the number of shares existing multiplied by market price plus new shares multiplied by issue price divided by total. Or if they give information like rights is in the ratio of 1:5, which means 1 right for 5 shares. So, this is 1, this is number of shares needed. So, you can do n into market price plus 1 into issue price divided by n plus 1. So, this will give you the theoretical X rights price. After you have calculated theoretical X rights price, you have to adjust rights, or you have to adjust bonus element, and to adjust the bonus element we calculate something called as right adjustment factor, which is nothing but your market price divided by theoretical X rights price. Now, this market price multiplied by theoretical X rights price, that is used to adjust the earnings per share. So, you have to when you have to restate the earnings per share, what you will do? You will take market price, you will divide it by theoretical X rights price, and you will calculate the adjustment factor. So, we will take one question here, so that it is easy for us to understand. Just let me share this. I will not share the screen because iPads it's not connected through a cable. So, I will directly write the numbers, and we will solve the part to it. Okay. So, a comprehensive question which will help us understand how to calculate EPS and all. Okay. So, on 1st of July of year 5, there are 500 million ordinary shares. 30th of June of year 5, profits were $250 million. First scenario, bonus issue made on 1st of November of year 5 in the ratio of 1:4. Now, when I say the ratio as 1:4, what it means is 1 share for 4 held. Now, whenever there is a bonus issue, you have to assume that bonus issue was made from the beginning of the period, or it was outstanding since the beginning of the period. So, you have 500 million shares, bonus issue is equal to 500 divided by 4. So, 4 250, 125. So, total shares is 125 plus 500, 625, right. So, that is the total number of shares which is outstanding. Now, earnings per share is equal to profits divided by weighted average number of shares outstanding. Now, profits is given to be $250 million, number of shares is given to be 625, this you multiply it by 100, right. So, 250 divided by 625 multiplied by 100, if you do, you get 40. So, this is 40 cents per share is the EPS. Though the bonus has been made on 1st of November, we gave full 12 months to calculate the weights, right. Now, the next part is 1 for 5 rights issue on 1st of February of year 6 at 1.25. Cum rights price is 1.4. Now, in such situation, how do we calculate? We calculate theoretical X rights price. 1 for 5, this is 1, this is n. So, 5 multiplied by price 1.25 plus, 5 multiplied by current market price 1.4 plus 1 multiplied by 1.25 divided by 5 plus 1, which is 6. So, 1.5 into 4, 7 plus 1.25 divided by 6. So, 8.25 divided by 6, if you do, you get 1.375 or 1.38. This is what theoretical X rights price. Now, when you have the theoretical X rights price, the next thing that you have to do is to calculate the bonus or the adjustment factor for the previous period. Now, here previous period fraction is not given. So that adjustment factor you can ignore as well, but we still need the adjustment factor for calculating weighted average shares. Okay, to calculate weighted average shares, we need the right adjustment factor. Now, on 1st of July of year 5, the number of shares outstanding is 500 million. Then issue happened on 1st of February of year 6 and it is what? 1 for 5. So, 100. So, now this 500 becomes 600. Why? 500 plus 100. Months. July to February. July, August, September, October, November, December, January. 7 months. 7 out of 12. This is 5 out of 12. Now, because this 100 includes some bonus element, we have to include that bonus element in the opening balance as well. Now, this 500 opening balance, whatever is there, for this we need to calculate an adjustment factor.
12:30.
Now, the way for you to remember is, I need to increase the number of shares. So, my numerator should be higher, denominator should be lower. So, higher numerator means the market price 1.4 divided by 1.38. Here there is no adjustment factor, it is 1. So, weighted average, if you see, 500 into 7 by 12 into 1.4 divided by 1.38. So, 500 into 7 divided by 12 into 1.4 divided by 1.38, whatever you get, 295.89. So, because we are calculating in millions, we can round it off to 296. 600 into 5 by 12 is directly 250. 250 plus 296, 500, 546. So, EPS is 250 divided by 546 into 100. So, 250 divided by 546 into 100, which is 45.78 cents. 45.78 or 45.8 cents per share. Are we clear with this? This is the only tricky part when it comes to rights issue, when you have to calculate theoretical X rights price, right adjustment factor and calculate the weighted average. Any question here?
So the first part of calculation can you show, sir?
Which one?
Above.
This one?
Right after the question. No, sir.
Above?
Yes, sir. Yes, sir. That's for bonus.
Bonus, no? So, you have to take fully.
Yes, please.
So, one thing you have to keep in mind, please ensure you see this this type or this pattern of question, because sometimes students get confused between this right adjustment factor, how to do and what to calculate, and it can be overwhelming just before the exams. So, please run through it once again so that it is very clear. Okay. Then we have diluted EPS. So, in diluted EPS, the thing is there could be something like a convertible debenture or a convertible preference share. So, what happens is you have profit available to shareholders to shareholders. This is as per basic computation. Okay, and you divided it by weighted average number of shares outstanding. Okay, now if there are convertible debentures, these debentures can become shares in the future. So what happens? The thing is, my number of shares will increase. Then also what happens is, because the debentures are converted, I don't have to pay interest. So earnings available will also increase. So you will do plus interest into 1 minus tax. Why tax? Because if there is no interest, tax will be higher. So interest into 1 minus tax. So profit available to shareholders as per basic plus interest into 1 minus tax divided by the weighted average number of shares plus converted shares. For this also you have to take weighted average. Now, if there are convertible preference shares, instead of adding interest, you will add dividend. Okay, and this converted shares will be assumed to be outstanding since beginning. But if I have issued this convertible debenture during the year, you will consider it to be outstanding from that specific date only. Okay, it's a very simple one. So you just need to have it. Now this brings us to largely I have covered the basic standards. Any more standard or topic you want me to cover? Exclude the consolidation part. Consolidation we have not yet come across. The initial part of the standards.
No, sir.
And has this been helpful for you to recap some concepts quickly?
Yes, sir. Yes, sir.
Okay.
It's like a revision for me again, sir.
Yeah, so it's a revision. So now what you have to do is you have to follow it up with the rigorous practice of MCQs. And I hope you are doing that.
Yes, sir.
Yeah, okay, great. Now we move on to the threatening aspects where there is some kind of confusion or questions can be longer and adjustments can be missed out. We will move on to group accounts. Largely focusing on first parent and subsidiary and subsequently we will take up the associates and equity method of accounting. Now when we say group accounts, there is a parent and there is a subsidiary. There can be more than one subsidiary also. Now when you have a parent and subsidiary, normally when the parent controls another entity, then we say the other entity is subsidiary and the first entity is parent. Normally control comes when you have greater than 50% voting. Control can come also through contractual arrangements, the ability to appoint directors, or you have taken or you have got the support of other shareholders who agree to vote as per the parent's instruction. So it can come in either ways. Most of the cases the question will give you very clearly parent holds, and we have been practicing, right, 80%, 75%, these kind of numbers is what you would be seeing. That is what is the parent and that is what is the subsidiary. Okay. Control, as I told you, can happen by exercising majority voting rights. Control can happen when you can appoint board of directors. Control can happen because if you look at it, you hold let's say 40% and other shareholders are scattered all across and they don't take decisions and all of that. In that situations also it happens. Or there is a potential voting right. I have convertible preference shares. I can convert the preference shares and then I can take the take the control. So multiple ways there are to get the control over other entity. Now large part of the discussion around group financial statements is preparation of consolidated financial statements. When we say consolidated financial statement, you have parent financial statement which has assets, equity and liability. You have subsidiaries financial statement which also has assets, equity and liability. In the separate financial statements they will prepare normally, but when an investor wants to understand as a group what is the financial performance, what is the financial position, we prepare something called as consolidated financial statement. So you have parent, you have subsidiary, and these are the broad components. Now under assets you have something called as investment in subsidiary here. Okay. Now when you consolidate the financial statement, the balance sheet for now, you take assets and merge them together. So asset plus asset. Investment in subsidiary is removed. Investment in subsidiary is removed and this equity is also removed. investment in subsidiary is removed, equity is also removed. Now in this equity, there is some ownership by the parent and there is some ownership by other non-controlling interest. So parent has the controlling interest, equity other holders have, they don't have controlling interest. So parent and this investment, these two knock off against each other. Other non-controlling interest remains, so that you will recognize under equity. Then your parent's equity and this liability plus this liability. Broadly, how they consolidate, taking 100% of the assets and liabilities of the subsidiary. Taking 100% of the assets and liabilities of the subsidiary. Now, when we understood the logic and all of that. I will quickly run you through how to prepare consolidated statement of financial position. So first step, what you need to do is you need to determine controlling interest and non-controlling interest. Normally would be given to you in the question. There is nothing there is no rocket science behind this particular calculation, right? Then second is to determine goodwill. Second and third step can be interchanged. When you determine goodwill, on one side you take fair value of consideration, or in most of the cases cost of investment. You will have some number A. Then you will take value of NCI. Now value of NCI can be measured using fair value method, proportion of net asset method. So either of these two methods, it will be given to you in the question. Okay, if fair value is given, you can apply the fair value method. If fair value is not given, you have to take the proportion of net asset method. Whatever is the number, that is the second part. You will do A plus B. C is equal to A plus B. Then you will calculate fair value of identifiable net assets. Let us say this is D. Fair value of identifiable net assets. Now, if fair value of identifiable net asset is more than A plus B, means there is a bargain purchase and there is a gain. And the second case is, if whatever you have paid A plus B is greater than D. So if C is greater than D, this implies that there is goodwill, and this goodwill is recognized in the consolidated statement of financial position, right? So if C is greater than D, there is goodwill. If D is greater than C, there is a bargain purchase. In that case, you have to go back and you have to look at the fair value of the individual assets and liabilities once again. Even after doing that, you realize that no, this is what is the fair value, it is properly done, then there is a bargain purchase gain which is recognized as a gain in the P&L. But most of the cases, you will have goodwill related scenarios. You have to calculate the what you have paid, what is the value of NCI, compare that with fair value of business, and if whatever you have paid is greater, then you say there is a goodwill. So that is the second thing. Then reserves. Whatever net assets you calculated here, this flows from the third step, which is reserves. You calculate on date of acquisition. So on date of acquisition, you have to see what is there. Share capital. What are their reserves on date of acquisition? Then if at all there is any fair value adjustment, you are increasing the value of property, plant and equipment, all of that you have to include here. Okay. So this total share capital plus reserves plus fair value adjustment on date of acquisition, this number will give you net assets. So this number here, this particular number, you just plot it here. Okay. Then you will also have reserves on date of reporting. And whenever there is a fair value adjustment, increase or decrease, if you have increased the value of an asset, there will be depreciation. So, there will also be additional, let us say, depreciation because of fair value adjustment. Difference between these two is post acquisition. XX minus YY is post acquisition, reserves, this is post acquisition, post acquisition, post acquisition. Normally, these two would be same. There would not be any changes at this level. So, you will consider these to be same. Reserves would change, fair value adjustment, depreciation, whatever is there is post acquisition, and the total of post acquisition is split between parent and NCI. It's split between parent and NCI. Okay. Then you determine NCI balance, that is balance on date of acquisition, whatever you have done, whether you have used the fair value method or proportion of net assets method, plus share of post acquisition profits. This will give you closing balance of NCI. I have not yet come to goodwill impairment and all of that, that will handle it separately. Then lastly, you have to take the consolidated reserves. In the consolidated reserves, you will take all reserves of parent plus share of post acquisition of subsidiary. This comes from your working note here, this number. Okay, so parent portion goes to number 5, NCI portion comes over here. This is the consolidated reserves that would be shown in the consolidated financial statement. Now, from subsidiaries financial statements, you will take all the assets, you will take all the liabilities, you will not take equity, you will not take reserves. So, where will we get the reserves from? You will get the reserves from this particular working. From the parent's balance sheet, you will take all the equity, you will take all the assets, you will take all the liabilities. Yes, there are intra-group adjustments and all of that I will be coming to subsequently, but this is the basic structure and you must follow this basic structure when you are solving a question. Sometimes there may be an MCQ question which may just ask you about, let us say, calculation of goodwill, or they may just ask you about calculation of post acquisition share of profit. In that case, you just need to work out the relevant working note given in the asked in the question. Any question in this part, whatever we have done?
Yes, sir.
Okay.
So the pre and post separation
We did know here.
Yes, date of acquisition.
Sorry?
So depreciation is fully post, no, sir?
Yeah, post only. So that is why I put it here.
Yes.
This will remain same. So here you will have 0 and depreciation will be they will take care of the remaining difference. And this depreciation, subsequent extra depreciation also will automatically be taken care in the post acquisition reserves.
Yes.
Okay. So this is the broad structure. Now moving to specific adjustment. The most commonly found is intra-group balances. So in one account there may be account receivable, in the other part there may be account payable. Whatever is the account receivable and account payable, let us say 5,000 account receivable, 5,000 account payable, you will eliminate this, you will eliminate this. So whatever intra-group balances are there reported by either the parent or the subsidiary, both of them would be eliminated. Sometimes what happens is account receivable, you may say 5,000 holding or parent, subsidiary says account payable is only 4,000. Why is the difference? Subsidiary has sent some cash, there is cash in transit 1,000. So in that case what you will do is account receivable 5,000 you will fully nullify and you will say cash in transit 1,000. Account payable also fully nullified. So on a net basis 5,000 minus 4,000, 1,000 would be shown as cash in transit. Very carefully you have to do the adjustment. Please remember entire balance should be removed from the payable and entire balance should be removed from the receivable as well, whatever balance is being shown. Okay. Now another very important adjustment is intra group trading. Intergroup trading means parent sells to subsidiary or subsidiary sells to parent. Okay. Now, if parent sells, so there are two situations. Let us say if subsidiary sells to parent and inventory is lying with P. Okay. Parent sells to subsidiary sells to parent, inventory is still lying with P, 50%, 30%, 40%, whatever it is. So, you have to calculate what is the unrealized profit made by the subsidiary, and because the subsidiary has made it, what you will do is you will go back here and here you will do an adjustment for provision for unrealized profit, that part you will adjust it out here. If subsidiary sells, you will adjust in the working note related to subsidiary. If parent sells, then also you will calculate unrealized profit. That unrealized profit will be adjusted in the consolidated reserves. So, if the subsidiary sells, you will adjust it from the reserves of the subsidiary. If the parent sells, you will adjust it from the reserves of the parent. Okay, that is what you will do with respect to provision for unrealized profit. Now, because there is a provision for unrealized profit, let us say 1000. By 1000, you will reduce the reserves. You will also reduce the inventory. Inventory also has to be reduced to the extent of 1000, which is provision for unrealized profit. Okay. Same treatment you will do for provision, or similar treatment happens when non-current assets are sold by parent to subsidiary or subsidiary to parent. So, whatever is the unrealized profit, you will eliminate in the same way as you eliminate unrealized profit from the for inventory sale. But one more thing that you have to keep in mind when there is an unrealized profit on sale of your non-current asset, depreciation should also be adjusted. Sir, why depreciation should be adjusted? Very simple. Let us say parent sold to subsidiary non-current asset, book value 10,000, sale value 12,000. So, this 2,000 of profit should be eliminated, that is the first thing. Second is the difference here, because actually you should charge depreciation only on 10,000, but the subsidiary will now charge depreciation on 12,000. So, this depreciation on this 2,000 should be adjusted. So, unrealized profit will be reduced. Because the depreciation has increased, you will now decrease the depreciation to the extent of the difference part. Okay. So, to that extent you will adjust the depreciation, and this will also have an impact in the P&L, that is the consolidated P&L and also the non-current asset. Okay. So, take up one question on inventory and also take up one question on non-current asset, and please try to solve it, because this is a tricky adjustment in the examination. Whenever you see parent selling to subsidiary or subsidiary selling to parent, please ensure you calculate the provision for unrealized profit correctly, your share, whatever is the share of holding and subsidiary, and then if parent sells, you have to adjust it from the parents. If subsidiary sells, you have to adjust it from the subsidiary. For non-current assets, subsequently depreciation will also be impacted. So, you will have to reverse the depreciation accordingly. Okay. Then if there are fair value adjustment on date of acquisition, what you will do? You will increase or decrease reserves. Increase or decrease reserves. You will increase or decrease reserves on date of acquisition column. So, here you will have fair value adjustment, and depreciation impact you will have on date of reporting. So, here you will have fair value adjustment, this will remain the same. Depreciation you will have it separately. So, whatever is the depreciation impact, will reduce the profit accordingly. This will be done in subsidiaries case only because you are revaluing or you are doing a fair value adjustment with reference to the subsidiary. Okay, and this net impact will be given to PPE because PPE also needs to be adjusted by the net amount. Okay. Any question in this? If conceptually this is clear, with practice you will be able to handle the questions very smoothly. There should not be any challenge at all.
Yes, sir. Concept is clear.
Now, sometimes there can be deferred consideration. Deferred consideration means parent says we will pay after 1 year, we will pay after 2 years, we will pay after 3 years. So, if there are deferred consideration, you will calculate the present value of consideration, and this present value of consideration or the fair value of consideration is what will be used for calculation of goodwill. The interest component will be recognized in P&L. Okay. So, that is with respect to deferred consideration. Then sometimes there may be contingent consideration. If there is any contingent consideration, you will calculate the fair value of the consideration and you will recognize it. Normally, any contingency we do not recognize, but whatever is the fair value of the contingent consideration, that you will recognize and that you will use to calculate goodwill or capital reserve. Okay. So, these two are the specific points that you have to keep in mind. When you read the question, you should figure out, is there any deferred consideration or is there any contingent consideration. Okay. Then things like if there are if you have to follow uniform, if the accounting policies are different, you have to follow uniform account policies. If it is a mid-year acquisition, you have to calculate profit till the date of acquisition and accordingly do the calculation. Okay. So, that covers the concept of your consolidated financial statements, right. And in the examination, very simple, do those 5 steps, any other working note, and line by line you just keep on adding, it will be more than sufficient.
Yes.
Yeah.
Those 5 working notes will be better.
Yeah, that is, you have to be very, very careful. If at all, see, sometimes what happens is, because in our classes we had time and all of that, what we were doing is, we were doing 3 subsequently and then we were doing 2. If you feel that no, we can do 3 this first and then goodwill next, that is also okay. Okay, yeah. So, we will conclude here. Tomorrow we will finish up the consolidated P&L part, and we will take a few questions after we finish up the consolidated P&L and disposal part. We will take up a few questions for quick practice.